Hey everyone, and welcome back to the channel. Today, we're diving into a forgotten chapter of American financial history, the Panic of 1893. The Gilded Age, on its surface, glittered with industrial might and soaring fortunes. Skyscrapers touched the heavens, railroads crisscrossed the continent, and millionaires became household names. But beneath this shimmering veneer of prosperity, deep economic fault lines were forming. Tensions between a booming industrial North and a struggling agricultural South, fueled by a ferocious debate over the very nature of America's money. At the heart of it all was the battle between gold and silver. For decades, the U.S. had operated on a bimetallic standard, meaning both gold and silver could back the dollar. But as gold discoveries dwindled and silver production soared, especially in the western states, the value of silver plummeted. Silverites, often farmers and debtors, wanted to coin more silver, hoping to inflate the money supply and make it easier to pay off debts. Gold bugs, mainly bankers and industrialists, fiercely advocated for a strict gold standard, fearing inflation and demanding sound money. In 1890, Congress tried to appease both sides with the Sherman Silver Purchase Act. This law required the U.S. Treasury to buy millions of ounces of silver each month, paying for it with notes redeemable in either gold or silver. The idea was to prop up silver prices and increase the money supply. But instead, it created a dangerous financial tightrope. As people lost confidence in silver's long-term value, they started redeeming those government notes for gold, rapidly draining the nation's precious gold reserves. Meanwhile, the railroad industry, once the engine of America's growth, had become a runaway train of speculation. Miles of track were laid, often duplicating routes, fueled by massive loans and often shady financial dealings. Companies expanded beyond what traffic could support, issuing mountains of bonds and stocks. This overexpansion created a colossal bubble of debt and unrealistic expectations. Many of these railroad companies were teetering on the brink, masking their financial fragility with complex accounting tricks and optimistic projections. As the Treasury's gold reserves steadily diminished, public confidence started to fray. Foreign investors, already nervous about America's bimetallic stance, began pulling their capital out of the U.S. Banks grew hesitant to lend, and the stock market became increasingly volatile. Everyone watched the gold reserves like a hawk. If they fell below a perceived safe threshold, the entire financial system could seize up. The air was thick with unease, a looming storm that few seemed to know how to weather.
Then, in February of 1893, the first major domino toppled. The Philadelphia and Reading Railroad, a massive company with extensive coal and transportation interests, declared bankruptcy. Its collapse was not entirely unexpected by those watching closely, but its sheer size sent shivers down Wall Street. This wasn't just another small failure. It was a clear signal that the underlying rot in the railroad sector was far deeper and more widespread than many had dared to admit. The dam was about to break. The news hit like a lightning bolt. The stock market, already skittish, went into free fall. Investors panicked, dumping shares of railroads, banks, and industrial companies alike. Fear rippled through the financial system, leading to widespread bank runs. People rushed to withdraw their deposits, converting their paper money into gold, exacerbating the Treasury's already critical gold drain. Credit dried up almost overnight. The entire edifice of American finance, built on trust and a perceived promise of convertibility, began to crumble. But the panic wasn't confined to the gilded halls of Wall Street. It quickly spread to the real economy. Factories, reliant on credit to operate, and customers with dwindling purchasing power began to scale back production. Businesses of all sizes faced immense pressure, unable to secure loans or collect on receivables. From steel mills in Pennsylvania to textile factories in New England, the industrial heartland of America started to feel the chilling grip of economic contraction. Jobs, once plentiful, evaporated rapidly. In the White House, President Grover Cleveland stood firm, a staunch defender of the gold standard. He believed that any deviation would shatter international confidence in American currency and plunge the nation into deeper chaos. His solution was clear: if politically unpopular, defend the gold reserves at all costs, even if it meant economic contraction and temporary hardship. He viewed bimetallism and inflation as dangerous threats to the nation's financial integrity, a moral failing that must be resisted. Cleveland's top priority became the repeal of the Sherman Silver Purchase Act, which he saw as the primary culprit draining the Treasury's gold. He called a special session of Congress in the summer of 1893, sparking a ferocious political battle. Silverites fought tooth and nail, arguing that repealing the act would only deepen the depression for farmers and workers. Despite intense opposition, Cleveland ultimately prevailed, but the political cost was immense, fracturing his own Democratic Party.
Even with the Sherman Act repealed, the gold drain continued, signaling persistent lack of confidence. The Treasury's reserves neared critical levels, threatening to force the U.S. off the gold standard entirely. In desperation, Cleveland's administration turned to the titans of finance. 4 times, most famously in 1895, a syndicate led by J.P. Morgan and the Rothschild banking family effectively bailed out the U.S. Treasury, purchasing government bonds with gold to replenish the nation's reserves and avert total default. These bond sales to private bankers, though controversial, temporarily stabilized the gold supply and averted a complete currency crisis. But the economic pain on the ground only intensified. While Wall Street breathed a sigh of relief, Main Street continued to suffer immensely. The infusions of gold did little to restart closed factories or put food on the tables of the millions now unemployed. The chasm between the financial elite and everyday Americans grew ever wider and more bitter. The human cost of the Panic of 1893 was staggering. Estimates suggest unemployment soared past 20% in some industrial cities, leaving millions without work or income. Soup kitchens and charity lines stretched for blocks. Families lost their homes, their savings, and their sense of security. The crisis wasn't just statistics on a ledger. It was a daily struggle for survival, a grinding poverty that exposed the stark inequalities of the Gilded Age and shattered the American dream for countless citizens. The widespread despair fueled social unrest. In response to the government's apparent inaction, a businessman named Jacob Coxey organized a protest march. In 1894, Coxey's Army, a group of unemployed workers, marched from Ohio to Washington, D.C., demanding that the government create public works programs to put people back to work. It was an unprecedented demonstration of direct action, symbolizing the frustration and desperation simmering across the nation. They sought answers and action. However, Coxey's peaceful protest met with a harsh reception. Upon reaching Washington, D.C., Coxey and other leaders were arrested for trespassing on the Capitol lawn. The government, wary of social upheaval and clinging to laissez-faire economic principles, had no intention of directly intervening to provide relief or jobs. This dismissive response further alienated the suffering populace and highlighted the deep divide between the political establishment and the growing demands for a more active role for government in managing the economy.
The panic also devastated the agricultural sector. Farmers, already struggling with low crop prices and heavy debt, found themselves in an even more desperate situation. The deflationary pressure caused by the gold standard meant their crops sold for less, while their debts remained fixed. Many faced foreclosure, losing their land and livelihoods. The crisis intensified their belief that the Eastern banks and the gold standard were conspiring against them, deepening the rural-urban divide that plagued American politics. Across the country, banks failed by the hundreds. Businesses, large and small, went bankrupt in record numbers. Industrial production plummeted, factories lay idle, and the nation's once booming economy ground to a halt. The cascading failures created a vicious cycle. Unemployment reduced consumer demand, which led to more business failures, which in turn led to more job losses. It was a stark reminder of how interconnected the financial and industrial components of a modern economy truly were. And make no mistake, this wasn't just an American crisis. As the United States was a major global player, the Panic of 1893 sent ripples across international markets. European investors, fearing losses, pulled capital from American ventures. The sudden contraction of the U.S. economy impacted global trade and commodity prices. It underscored the emerging interconnectedness of the world's financial systems, demonstrating that a crisis in one major economy could quickly become a global contagion. The political ramifications were profound. The panic discredited the Democratic Party and accelerated the rise of the populist movement, which advocated for government ownership of railroads, a graduated income tax, and crucially, the unlimited coinage of silver. While Bryan ultimately lost the election to William McKinley, his powerful rhetoric captured the despair and hope of millions, solidifying the monetary debate as the central issue of the era and marking a turning point in American political discourse. That campaign was in 1896, and its defining moment came from William Jennings Bryan. His electrifying Cross of Gold speech at the Democratic National Convention championed the cause of silver and the common man against the crucifixion of the gold standard. While Bryan ultimately lost the election to William McKinley, his powerful rhetoric captured the despair and hope of millions, solidifying the monetary debate as the central issue of the era and marking a turning point in American political discourse.
The Depression slowly began to recede in the late 1890s, aided by a return of business confidence and, ironically, new gold discoveries in Alaska and South Africa. These discoveries increased the global gold supply, effectively expanding the money supply without abandoning the gold standard, thus appeasing some of the Silverites' concerns. Industrial activity cautiously resumed, unemployment began to decline, and the nation gradually pulled itself out of its profound economic slump. But the scars remain deep. The Panic of 1893 left an indelible mark on America's economic landscape. It forced a critical reevaluation of the country's monetary policy, eventually solidifying its commitment to the gold standard until the 20th century. It also revealed the vulnerabilities of an economy driven by unchecked speculation and highlighted the urgent need for more robust financial regulation, ideas that would gain traction only decades later during future crises. Its lessons echoed long after the immediate hardship subsided. In the aftermath, the United States officially adopted the gold standard with the Gold Standard Act of 1900. This move was a decisive victory for the gold bugs and ended the century-long debate over bimetallism. While it brought monetary stability and reassured international investors, it also meant that the money supply would be largely tied to the amount of gold available, limiting the government's ability to stimulate the economy during future downturns, a lesson still being debated today. So, what can we learn from the silver panic? It underscored that monetary policy isn't just an abstract economic concept. It has profound real-world consequences for every citizen. It revealed the dangers of unchecked speculation, particularly in emerging industries like railroads, and it illustrated the fierce political and social conflicts that can arise when economic hardship collides with entrenched ideologies about how money should work. History consistently reminds us that financial decisions have far-reaching human impacts. The Panic of 1893 remains a powerful testament to the fragility of economic systems. It demonstrates how a combination of flawed policy, speculative excess, and a crisis of confidence can unravel even a prosperous nation. This period of intense suffering ultimately pushed America towards a stronger, if still imperfect, understanding of its financial infrastructure. It's a story of hardship, but also a vital lesson in the perpetual balancing act required to manage a nation's wealth and secure its future.